So in today's video, I'm going to be jumping in and showing you the 3-step process that we use to submit offers on multifamily deals on a weekly basis. In fact, we've submitted over $50 million of offers this week alone, and I'm going to be showing you how. So before we jump in and start talking about underwriting and submitting offers, you have to start with the foundation. And I see so many investors make the mistake of trying to jump into the business, but they have no idea what they're actually looking for. So the first step to our process is, number one, you have to define what a great deal is. And what I mean by this is everybody has their own opinion, and there are so many different ways to make money in multifamily, and no one way is the right way. As long as you're making money, you can do whatever you want, but you have to be the one to define what a home run deal is. Now, number two, which oftentimes might lead to you answering number one, is you have to define the how and the who you'll partner with to actually close the deal. Assuming you don't have a bajillion dollars sitting on the sidelines and you can just go and buy unlimited deals, it's most likely that you're going to be bringing in partners to do these deals. And regardless of what you think is a great deal, you have to get these partners on board as well. So sometimes if you go out and you find a potential partner and identify what a great deal to them is, it can then help you define what you should be looking for. And so to give you a visual, everything revolves around the deal. In this business, the deal dictates everything. Now, every deal is going to be different, but I wanted to break it out and give you a visual because in the second piece of this, I say define how and who you'll bring in to partner with. And oftentimes at the beginning, if you have no experience and if you've never done it before, you're going to need other people's help. So you need to figure out how you fit into the transaction, and it all revolves around the deal. Now, a couple of different pieces of it. You have finding it, so you could go out and find a great opportunity and bring it to an investor like me, and we could potentially partner on it. Then we have the funding it or raising the capital portion of it. So maybe you're not the best analytical person, you don't know how to operate through a fancy spreadsheet, but you're a well-connected person and you know investors that might be willing to invest into an opportunity if you brought it to them. You could fit into the deal by raising some capital for it and getting a piece of the ownership. Then we have what I like to call the experience side of it, or execution of the business plan, and being able to manage the due diligence process and actually getting a deal closed. And so these large multifamily deals, it's much different than a single family home because there's so many moving pieces. That's why it's so hard to go at this business alone. You need other people. And I see people in our community putting deals together on a weekly basis because they understand what actually makes up the entire deal itself. So again, step one, before you go out looking at deals, you need to define what a great deal is, and then more importantly, the how and who you're going to bring in to actually get it closed. If you don't have this solved for, you are going to run into a brick wall over and over and over and over and over again. I don't want you to do that. Now, moving on to step number two of the process, we've defined this as the TDR process because this is what we do every single week on Tuesday night. We look at live deals, and this is the exact same process we use every single time. So assuming I know what a great deal is and I have potential partners to bring it to, I'm now going out and I'm looking for opportunities to look at. As soon as I see a deal or I go to Crexy.com and I find an opportunity, this is the way that I am looking at it. And I'm breaking our process down into 3 separate sections. Number one, the deal. Number two, the location. And the last one, which is the financial side of it. I see so many investors only focus on the underwriting and what the projected returns might be, but they're forgetting the most important pieces, which is the deal itself and the actual location that the property is in. And you see right down here, I have a green checkbox and a red checkbox. If I can't get past the deal or the location, I don't care what the numbers actually say, because I will not go and buy a deal just based on what the financials say. I want to make sure it's a great deal in a great location, and then we can worry about the financials. So hitting on each one of these, what do I mean by the deal? What I mean by it is, what is the condition of the property? What age was it built? What is the deferred maintenance? Do we have to go in and replace the roofs? Do we have to go in and renovate all of the units? And then you see right here, it says story. This is super important. Whenever you reach out to the broker or a wholesaler, if it's an off-market property, there's always going to be a story behind why they're selling it. So for example, in 2025, when I'm looking at deals, the story that I'm looking for oftentimes is I'm looking for distress or motivation to sell. So whenever I jump on a phone call with a broker and he says the seller of the property bought the property in 2021 or 2022 and they put a short-term loan on it and the loan is coming due and they are in trouble, that signals to me motivation to get out of the property and presents a fantastic opportunity for us as the investor. So I'm looking for the condition, I'm looking for the story, and then these last two are the most important piece, which is the projected business plan, or where I can take it, or the potential of the property after we go in and renovate it and fix it up. So as the deal comes out, I'm going through and I'm checking off what's the condition. Is it in okay shape? Do we have to put a ton of money into it? Or is it a lighter value add deal? That's what I look for. And I'm getting the story from the broker and I'm putting together what is the potential, where can we take this thing, and how much money can we actually make on it. If I like what I see, then I go ahead and I move on, I check the green box, and now I'm gonna go into looking at the actual location. And to simply explain location, there's so many things we can touch on. We are in the apartments business. Our business is to lease apartments or space, like 4 walls, to people. And so I like to go into markets that have a lot of people. If you go into markets with smaller amounts of people, you are inherently taking more risk because there's less people. And in the world of business, not just apartments, everything is based on supply and demand. And so if we're in a location like Florida where there's so many people coming in on a daily basis and there's only so much supply available, then it's a good chance, 1, you're gonna be able to lease the units, and then 2, you're gonna be able to increase the rents as time goes on. So I'm looking for markets that are a growth-oriented market. For example, markets I stay away from, if you go to Chicago or Detroit, these are declining markets where companies and people are actually moving out from. So we want to position ourselves as investors in markets where they're growing long-term, and maybe we're lucky and we can increase rents more than we actually anticipated to. Now, population, this is market by market and investor to investor. So generally speaking, I want to go into a market within a 5-mile radius. There is a minimum of at least 100,000 people in that area. Now, it doesn't mean that if there's not 100,000 people, you shouldn't look at the deal. We've invested millions of dollars into markets with smaller populations than this, but you just need to understand how to determine the amount of risk that you're taking going in. So as a buffer, if there's more than 100,000 people, then I like what I see. Now this one right here, make sure to write it down. This is a golden nugget, which is the rent to income ratio. So whenever you go and you lease an apartment, they ask you to verify your income, and most of the time that income requirement 2.5 to 3 times the rent amount that you're paying every single month. So if I'm gonna go into a market and I'm renovating the units and I'm taking the rents from $1,750 to $2,000, that means that person is paying $24,000 a year in annual rent. If that person's income is $50,000, that means 50% of that person's income is going towards rent, which is not an affordable market. That's like Miami. Now, a good rule of thumb is if it's less than 25 to 30% of the median income in that area, then that is a good bet that you can make. Meaning the people that are gonna be renting your units when you're done with it can actually afford it. And then the last one I throw up here is safe. I do not want to go into neighborhoods just because, again, you might be persuaded by the numbers on the deal to go into a questionable location. I'm telling you now, the numbers look great on paper, but as soon as you close and you try to collect rent, then you start questioning on why you went into the deal in the first place. Go to neighborhoods, when you tour it, you would feel comfortable bringing your wife and walking your dogs outside or your kids, and if you don't, then don't buy the deal. So I checked off the deal, I moved on, now I'm going through the location, I like what I see, I'm gonna check the box, and again, if I don't like the location, I'm passing. I don't even look at the numbers. I don't want to get lured in and overlook the location just because of how good the numbers look. If I get through the deal and the location, then we look at the financial piece. I want to look at the seller's financials as kind of like a doctor. This is a really good analogy. If you can look at the T12, the last 12 months of all of the income and all of the expenses, you can kind of look at it like it's your patient, and the financials are the health charts, and you're kind of looking at, is it in good health? Is it like dying? Do you need to put it on the surgery table and save it? And it's a really good indicator of what the physical property is doing right now. But what I look for as an acquisition is absolutely non-negotiable positive cash flow out of the gate. I have to be paid every single month in cash flow or I won't look at the deal. Now, the cash flow is just one piece of the deal. You don't really make a ton of money on it. You just don't want to go into a deal and lose money out of the gate. Where you make a lot of your money is going to be the upside on the rents. And so if I can move rents from $1,000 to $1,200, or from $1,200 to $1,500, or $1,500 to $1,800, you kind of see what I'm talking about through renovations. That increases the value of the property so much more than the cash flow coming out of the gate. And it's value add investors. This is where almost all of the money is. Now, to understand how we're going to get the upside, it's not like we can just take over the property, magically wave our wand, and expect tenants to pay hundreds of dollars more in rent every month. That ties into the CapEx budget, which is capital expenditures or just renovations to the property. As value add investors, we identify properties that maybe are mismanaged or maybe they're outdated, and we can go in and operationally make it better and physically make it better through interior unit renovations along with maybe exterior as well. So we buy the building, make it nicer, make it prettier, and because we're doing it and we're professional management, we're able to increase the rents, which creates a ton of value to the property. And how I make decisions, this is probably the biggest reason why people don't take action, is because they don't understand how to back into the net investor returns. So if you're going out and you're buying a deal, it could have an amazing story, it could be in a great location, but if you pay an astronomically high price and you can't produce enough profits, especially if you're raising money from investors, you're not going to be able to close the deal. And so how I end up making the actual decision of what price I can pay is I look at all of the profits that we could potentially generate from the property, and then we take into account all of the risk that we're taking as investors because of the age, because of the execution, and all of the things that happen between closing and actually selling it. You want to look at everything all in one. What are the returns to the investors? And is that a good enough return to attract the investor to say yes? If the deal positively cash flows, there's upside on the rents, and we understand how we're going to achieve the upside by our renovation plan, then we're going to move on and we can move to step number 3, which is the last step in the process, which is submitting your LOI plus getting your team on board. This is why step number 1 is so important, because if you're going at it alone, it's almost impossible to do deals. So within this step, number 1, determine the price you can pay, regardless of what the broker or the seller wants for the property. We are in a buyer's market. So like the last deal that I just acquired, the broker and the seller told me they wanted $4.5 million for it. We ended up buying it for $3.9 million because that's the price that we could pay for it based on our returns. So we underwrote it and we determined what price we could actually pay for the asset. Unless you want to look like a complete fool when trying to go out and get partners and raise money for it, you absolutely have to go and tour the asset specifically with the team or partners that you're trying to bring on board. And after you went and toured it, you confirmed the asset is the physical asset you thought it was. There was nothing crazy that the broker lied about, and it's actually in the location that you think it is. Like, it's a human test. You can go and try to study CoStar and look at Google News articles of like all the growth that's happening in that specific market. But when you go and drive and physically tour the asset, you know whether this is a good location or something you should stay away from. And we know the price we can pay. Then we finish it off by submitting the letter of intent and assembling the team. So the deals that we submitted on this week, they came out within the last month. We know what we're looking for. We underwrote it, we went and saw it, and then we determined what price we could pay. We submitted the offer, and now it is out of our hands. This is when it becomes a non-controllable, where other people are submitting offers on it. And we've done, as buyers and investors, we've done everything that we possibly can to get the seller or broker our best and final offer, and then we go from there. And that right there, ladies and gentlemen, is the step-by-step process that we use on a weekly basis, not only ourselves, but hundreds of members inside of our community to submit hundreds of millions of dollars of offers. It is not as crazy and as hard as it is, as most of these gurus actually make it out to be. We just like to simplify things here. So again, the what, how, and who, really important. You have to know what a great deal is and have some people around you. And then understanding the vetting process of how to underwrite it, know if it's a great deal, great location, and then submitting the offers. Like, most people just don't have the conviction or confidence in themselves to submit offers because they don't know what they're doing. So I challenge you, take what you learned from this video and go out and implement it, and let me know how far along in the process you get. And as always, if you found any value in today's video, make sure you drop a like, comment, and most importantly, make sure you hit the subscribe button. I will see you in the next one.